A common saying in finance is time in the market beats timing the market. So, should you invest all of your money in one go into investments or drip feed them in over time? This is known as lump sum investing versus dollar cost averaging. And in this video, we'll look at the pros and cons of both. As always, this is not financial advice. So why is this even a question? If time in the market is the most important factor, then getting all of your money in as soon as possible is the best option, right? Well, imagine investing all of your investment money into the stock market, you're feeling good and on your way to becoming financially free, then the market crashes and you've lost what you invested. To make you feel extra good, your friend might then invest after the crash and get the same stocks as you at a discount. This is an example of lump sum investing, where you invest all of your available capital in one go. Dollar cost averaging would instead be if you had invested your money over time. For example, if you had $12,000, you could invest $1,000 a month over a year. Taking $1,000 from your salary and investing it every month would also be similar, but if your total investable capital is $1,000 per month, then you effectively are making a series of small lump sum investments. So then, what are the advantages of investing everything in one go? In most cases, the market will not crash significantly soon after you invest, but only if you hit the like button and subscribe. Vanguard actually did a study looking at dollar cost averaging versus lump sum investing. They used data from the UK, the US, and Australia, looking at the different returns based on the two strategies. They found that in 2/3 of cases, lump sum investing outperformed dollar cost averaging. They also noted that typically a longer time period of dollar cost averaging would lead to a larger underperformance. In another example taken from Of Dollars and Data, if we look at investing a lump sum versus dollar cost averaging over 24 months in the S&P 500, in 78% of cases since 1997, lump sum investing would have outperformed dollar cost averaging, overall by about 8.8% on average. In the chart, times below the line show times when lump sum investing brought higher returns than dollar cost averaging. Notice that the times where dollar cost averaging actually outperformed lump sum investing were only during market crashes, such as in 2000 and 2008. Also bear in mind that this is not exclusive to the stock market. Similar results with dollar cost averaging underperforming lump sum investing in most months have been seen with gold and with Bitcoin. I'll leave a link to the full article in the description. Naturally then, the next question is, why would you dollar cost average instead of investing a lump sum? Overall, there is a higher risk when investing in a lump sum. This is seen as a higher standard deviation, which means how much variability there is in returns in this case. This basically means that there is likely to be less volatility in a dollar cost averaging investment compared to lump sum, which makes sense if you think that with dollar cost averaging, you don't have full exposure to the asset until all of your money is invested, unlike with a lump sum where all of your money is invested straight away. It also means that if there is a downtrend, then you buy into the trend, meaning a lower entry cost than had you invested before the crash. Another element is the psychology or the automation. If you are purchasing on a fixed date each month, then it takes the temptation of trying to time the market out of the equation. In summary, from a purely numbers point of view, lump sum investing seems to outperform dollar cost averaging more often than not, even on a risk-adjusted basis. However, an advantage to dollar cost averaging is to minimize the short-term risk if you think a crash is imminent, and to help avoid regret of investing just before a crash. Check out the channel for more finance videos, and as always, thanks for watching.